What is going on? Welcome back to Fanatic Journey. So today we're going to talk to you about Serve Robotics. I want to go over some of the current data points, break it down on the 2 reasons why Serve is really going down, and go over everything else you need to know. But first, make sure to hit that thumbs up, and with that, let's get right to it. So starting off on Friday, it did go down 5.4%. Very little volume as well, so 3.6 million shares being traded, 26.6 is the average. So that's been a little bit more of a common occurrence, lower volume, and lower volume does typically incentivize more manipulation. And in Serve's case, it's heavily shorted. So that is point number 1 on why Serve has been going down. Just lack of buyers, increase in manipulation. Again, it's pretty straightforward for that. But there's also a second thing that I'm going to talk on in a second. But these are all the transactions that have been occurring over the last 90 days on the secondary market, above $100,000. So on Friday, you did see a fair amount of transactions, kind of mixed, some buying, some selling, based on the bid, the ask, and the selling price. Everything that does show as a ask is a buy. On the flip side, everything that shows as a bid is a sell. So you did see some institutions paying attention to it, so that's relatively a good thing. These are some of the transactions on the dark pool. So dark pool is often enough linked to shorting. So definitely shorts were relatively active, and like I already mentioned, it goes hand in hand with lower volume. Shorts a little bit more active, they can pretty much move it how they see fit. Looking at some of the recent news, so this has been my problem with a lot of these stocks that really skyrocket, get a lot of popularity. They don't really put out substantial pieces of news. Whether they don't have it or not, that's yet to be seen. But a lot of these companies dilute. And lo and behold, that's actually one of the main reasons why Serve is going down, is because they did dilute right here. So you can see in July, and then this right here just closed on August the 28th. So 20 million private placement and warrants. So if you kind of open this up, it has a lot of different prices. So you have $10, you have $9, $6 as a conversion price, and then you also have $10. So yeah, you can go through each and every individual one, but going forward, this is what you want to pay attention to. So 5 years out, 5.5 years out, the conversion price is $10 a share. And yes, you are supposed to give these individuals kind of a premium discount, if that kind of makes sense, to really incentivize them to buy it. But at the same time, a lot of the broader market is looking at this as what the company sees as somewhat the fair value, and also not only that, they're compounding future growth. And so I think ultimately, any acquisitions kind of follow the same criteria. I think more notably, a lot of people are familiar with Twitter. So when Twitter got their initial offer, I think it was $44 first offer. Don't quote me on that, but you guys get what I'm saying. This price immediately jumped to $44 because that's what now the fair value was being seen as. So if the market disagreed, it could have stuck to 36, 38, many things like that. And these types of scenarios follow the same criteria. If the company says that the conversion price is going to be at $5, guess what happens to the stock price? It will go down and gravitate towards that $5 mark, right? So essentially, this is why it killed the momentum once again. And so it kind of shows that the future value in roughly around 5.5 years, not counting discount, is around, let's say, $10. They should have really put this at 15, if not a little bit higher, because that would show a lot more future growth. And as well, might even show that these individuals are getting still a good deal. So it's a very bad scenario, more psychological rather than anything, but still, if you couple that with lower volume, this is why you do get more of a hit based on the stock price, and why it's down about 15% over the last 5 days and down 58.92% over the last 1 month. So it's a, like I said, unfortunate kind of scenario that is playing out. It could all definitely change if the company just put out some substantial pieces of news, which again, there's a lot of different things coming out in the next little bit. So a lot of big tech conferences that Serve could really benefit and present at. So I think one is going to be September the 9th to the 12th. And so that's the Goldman Sachs Tech Conference, if I remember correctly. Everyone and their dog seems to be presenting there. So that is a good opportunity for Serve. I don't know if it's too late for them to really jump on that bandwagon. But As of right now, shorts did return about 1.58 million shares. That is net. So they were fairly active throughout the day, but in the end, they did return quite a lot. And I think has to do with just it being a long weekend, very high cost to borrow. So the cost to borrow average is 342.89%. Who wants to hold that over a long weekend? Nobody, right? So this is why, not just with SERV, across the board, you saw kind of a reduction in shorts. 20.21% of the free float is being shorted, works out to be 4.05 million shares. Utilization is 96.63. Short score is 81.46. So yeah, I think all in all, this stock is still a squeeze play. It just will come down to news. And actually, sorry, to go back over to this as well. This is also, I think, future dilution is playing a part into why it's going down as well. So it's kind of 3 points, not necessarily just 2. But yeah, I think all in all, it could definitely change. We've seen this happen in the past on many stocks, and even in SERV's case. Just one thing will change the whole dynamic of it really trending higher. Looking at options, 168,000 in calls, 338,000 in puts, 53% of all the options being done were optimistic and bullish. This is the kind of layout right now. Actually, I'll move to open interest. So you do see more on the low end, roughly around $8. On the optimistic side, roughly around $11. So that seems to be where Wall Street is anticipating for it to kind of trade between in the foreseeable future. So that's kind of a good thing. With us right now at 855, it does really show that there is a lot more upside rather than down, especially like I said, going back over here, they're kind of using $10 as a benchmark. So yeah, in all honesty, right now it could be seen as a pretty good discount play right now, or a value play if that makes sense. But with it right now at $8.49, it is trading between this S3 and this S2, very wide gaps. So just anticipate a lot of volatility in the foreseeable future, but $8 is going to be the strong support that you want to watch for it to hold. 907 is going to be that next strong resistance / target. In my opinion, I think especially with a lot of big tech unveiling their earnings next week, that could really gain some momentum in the broader market and really propel SERV to these 2 points, so the S2 and this S1. So let me know your thoughts. Don't forget to hit that thumbs up. Have you been buying? Have you been selling? Do you still think that SERV is a squeeze play? And yeah, what's your overall thoughts on it? Don't forget to hit that thumbs up. Hopefully everyone's having a good weekend. And make sure you guys definitely take advantage of this promo. Simply sign up for a new account, throw $100 at it. They give you 5 free stocks. Each stock is valued up to $2,000. So this is a kick-ass deal. Link in the description below and also the comments. With all that said, appreciate all of you watching.